On May 15, 2026, China's Ministry of Commerce reclassified silver as a strategic resource subject to immediate export licensing controls. The announcement used careful diplomatic language: national security concerns, domestic industrial requirements, resource conservation. But here is what the directive actually means. No silver leaves China without explicit government approval, and as of right now, 0 licenses have been granted. China is not just limiting silver exports, they have functionally stopped them completely. China produces approximately 3,600 metric tons of refined silver annually. That is about 115 million ounces, roughly 12% of global mine production. But that production number is misleading, because what actually matters to Western markets is not what China mines, it is what China exports. And that number is significantly larger. When you account for refined bars, semi-fabricated products, and the flows moving through Hong Kong intermediaries, China has been a net exporter of 80 to 100 million ounces per year. That silver has been flowing into COMEX vaults in New York, LBMA vaults in London, and directly to industrial fabricators across Europe and North America. As of May 15th, that flow stopped. Silver is currently trading at $33.40 per ounce. The price jumped 3.8% when the export ban was announced, then settled back to close just 1.2% higher by end of week. On the surface, the market absorbed the news. A small bump, some volatility, then back to normal price discovery. But the vault data is telling a completely different story. And once you understand what is happening inside the physical delivery system, that 1.2% move stops looking like rational price discovery. It starts looking like the last moment of calm before a supply shock that could send silver into a vertical price move within the next 90 days. There is a specific historical precedent for this exact scenario, a moment when a dominant producing nation cut off exports of a critical material. The market initially dismissed it as temporary, and then, 6 months later, prices had increased 700%, and Western governments were scrambling to secure emergency supplies. I will walk you through that pattern step by step and show you why the timeline matters more than the immediate price reaction. But first, you need to understand what this export ban actually means for physical silver availability in the markets that set global prices. Welcome to the Capital Wire, where we track the supply chains and capital flows the financial media ignores. Hit that subscribe button and turn on notifications, because what happens in the next 90 days will determine whether silver reprices violently or whether alternative supplies emerge to stabilize the market. Let me show you what the data is already revealing. Let me start with what the Chinese directive actually says, and then show you what it means in practice. The official announcement from China's Ministry of Commerce establishes a licensing system for silver exports. Technically, it is not a complete ban. Companies can apply for export licenses if they demonstrate the silver is destined for approved bilateral strategic partnerships and provide end-user certifications proving the metal will not be re-exported or used in military applications. Here is the critical detail. Industry sources in Shanghai and Shenzhen report that while the application portal is open, processing times are indefinite, and no approvals have been issued since the directive took effect. Chinese refiners who have exported silver for decades are being told their applications are under review. The message is unmistakable. Silver is staying in China. Now, let me show you why this matters specifically to the markets where silver prices are actually set. COMEX registered inventories, the category of silver available for immediate physical delivery against futures contracts, currently stand at 63.7 million ounces as of last Friday's report. Total COMEX inventories, including both registered and eligible categories, are approximately 288 million ounces. That sounds like a substantial buffer, and for years, analysts have pointed to these inventory levels as proof that silver supply is abundant. But those inventories have been declining steadily since January 2025. In the past 17 months, total COMEX silver inventories have dropped by 94 million ounces. That is a 25% decline that has been gradual, quiet, and almost entirely ignored by mainstream financial media. The reason those drawdowns have not accelerated into a crisis is that Chinese exports have been filling the gap. Industry data from customs reports and refinery shipments shows that approximately 35 to 40% of the silver that has been replenishing COMEX vaults over the past 2 years came from Chinese refiners and Hong Kong intermediaries. If that flow stops for 90 days, COMEX registered inventories will drop below 45 million ounces by mid-August, based on current delivery demand and industrial offtake rates. If the ban becomes permanent, and I will show you in a moment why that is the likely scenario, COMEX registered inventories could fall below 30 million ounces by the end of 2026. Now, 30 million ounces still sounds like a meaningful buffer, but let me put that number in context. Annual silver demand in North America alone, including industrial fabrication, investment demand, and jewelry, runs approximately 180 million ounces. COMEX registered inventories of 30 million ounces represent less than 2 months of regional consumption. For a market that prices globally and settles physically in New York, that is not a buffer. That is a structural emergency waiting to happen. London shows the same pattern with different scale. LBMA vaults currently hold approximately 1.04 billion ounces of silver, but available inventory, meaning metal that is not already allocated to ETFs, allocated accounts, or encumbered by lease agreements, is estimated at 240 to 280 million ounces. Chinese and Hong Kong flows have accounted for roughly 18 to 22% of LBMA inventory replenishment over the past 18 months. If those flows stop, available LBMA inventories will begin tightening significantly by Q3 2026, particularly if investment demand accelerates in response to supply concerns. And here's the feedback loop that creates price shocks. When investors perceive physical scarcity, they buy more, which accelerates the inventory drawdown, which increases the perception of scarcity, which drives more buying. Here is the detail that most analysts are completely missing. This is not just about total supply. Global silver mine production is relatively stable. Recycling exists. Secondary supply can increase. But what has been balancing Western markets for the past 2 years is not mine production or recycling. It has been the steady, reliable flow of Chinese exports filling the gap between Western demand and Western primary supply. That marginal supply, the last 80 to 100 million ounces that keeps inventories from collapsing, just disappeared. Before we go deeper into why China made this move right now, I want to know how you are processing this information. Are you tracking COMEX and LBMA vault inventories as part of your investment thesis? Or is this the first time you are seeing physical supply data presented this way? Drop a comment and let me know if you are focused on vault drawdowns or if you are watching primarily price action. I read every comment, and it helps me understand what analysis serves this community best. Now, let me show you why China banned silver exports in May 2026, and why this is not a temporary policy response. To understand why China implemented this export ban right now, you need to look at 3 converging strategic priorities that have nothing to do with silver's price, and everything to do with China's long-term economic and geopolitical positioning. The first priority is semiconductor and advanced technology manufacturing. Silver is a critical input in photovoltaic solar cells, 5G infrastructure, advanced semiconductor fabrication, and electric vehicle components. China has been aggressively expanding domestic semiconductor production capacity since U.S. export controls on chip technology escalated in 2023 and 2024. By 2026, China manufactures approximately 42% of global solar panel production and is the fastest growing producer of advanced semiconductor components outside Taiwan and South Korea. Both industries are heavily silver intensive. China's domestic industrial silver demand has increased by an estimated 28 million ounces annually over the past 3 years. That is new structural demand that did not exist in 2023, and it is demand the Chinese government has explicitly prioritized as essential to technology self-sufficiency. If you are China and you are choosing between exporting silver to Western industrial users or retaining it for your own strategic technology industries, the decision is obvious. You keep it. The second priority is monetary and reserve strategy. China has been the world's largest official gold buyer for over a decade, but while gold purchases are reported to the IMF and widely tracked, China does not officially report silver reserves. However, customs data, refinery production reports, and import flows analyzed by independent researchers suggest that China has been quietly accumulating silver through state-owned enterprises and sovereign wealth structures since at least 2019. Conservative estimates place Chinese state and quasi-state silver holdings at 450 million to 850 million ounces. Why accumulate silver when gold is the traditional monetary metal? Because in a commodity-backed trade settlement system, which China has been actively building through BRICS expansion and bilateral currency agreements, you need a diversified basket of hard assets. Gold for large value settlements, silver for smaller transactions and industrial backing. Critical metals like rare earths and lithium for technological leverage. If China is positioning for a post-dollar international monetary architecture, and all available evidence suggests they are, then accumulating silver while simultaneously restricting competitors' access to that same asset is textbook strategic resource control. You increase your holdings while creating scarcity for your economic rivals. The third priority is geopolitical leverage. Silver is classified by the U.S. Department of Defense as a critical material for national security. It is used in missile guidance systems, radar arrays, electronic warfare platforms, naval systems, and advanced munitions. By restricting silver exports, China is not just tightening industrial supply chains. They are creating strategic material dependence. If Western nations cannot source adequate silver for defense production, they either draw down existing strategic stockpiles, which are limited and politically sensitive, or they negotiate with China from a position of material weakness. This is the exact playbook China executed with rare earth elements in 2010. Export restrictions created supply panic, prices spiked, and China gained significant negotiating leverage on multiple geopolitical fronts. So here is the chain of causation. China's domestic semiconductor and clean energy demand surges. State accumulation of monetary metals accelerates as BRICS currency alternatives develop. Geopolitical tensions with the West intensify around technology, trade, and Taiwan. Silver gets reclassified as a strategic resource under national security provisions. Export licensing controls get implemented immediately with functionally zero approvals. This is not a temporary trade dispute. This is a structural realignment of global commodity flows in a fragmenting international system, and the consequences for Western silver markets are only beginning to materialize. If this analysis is giving you a new perspective on what is actually driving metals markets right now, hit that like button. It tells the algorithm this content is valuable, and it helps the Capital Wire reach more investors looking for this level of supply chain analysis. Now, let me show you the historical precedent that predicts exactly what happens next. In September 2010, China controlled approximately 97% of global rare earth element production. Rare earths are critical inputs for electronics, clean energy technology, and military applications. Western nations had systematically outsourced rare earth production to China over 2 decades because it was cheaper, environmentally easier to offshore, and China had large, accessible deposits. Following a maritime territorial dispute with Japan in the East China Sea, China quietly began restricting rare earth exports. It was not announced as a ban. It was implemented through administrative delays, suddenly enforced environmental regulations, and tightened export quotas that reduced shipments to a fraction of previous levels. For the first 4 to 6 weeks, prices moved modestly. The market treated it as diplomatic posturing. Analysts called it temporary. Industrial buyers assumed existing inventories would carry them through until the dispute resolved and normal trade resumed. Then, physical reality set in. By November 2010, rare earth prices began climbing meaningfully. By December, panic buying had started among industrial users who suddenly realized Chinese supply was not coming back quickly. By March 2011, some rare earth oxides had increased 500% to 900% from pre-restriction levels. Neodymium, used in powerful magnets for hard drives and electric motors, went from $50 per kilogram to over $500 per kilogram in less than 6 months. Western manufacturers faced production delays. Defense contractors lobbied governments for emergency stockpile releases. The price spike created a feedback loop. Scarcity drove buying. Buying accelerated inventory drawdowns. Drawdowns increased scarcity perception, which drove more aggressive buying at any price. China maintained export restrictions for approximately 18 months. Prices remained elevated for nearly 3 years. Western nations scrambled to develop alternative sources in Australia, the United States, and Canada. But bringing new rare earth production online took years and billions in investment. By the time alternative supply emerged, China had demonstrated that control over critical material supply chains is geopolitical power. Now, silver is not identical to rare earths. The silver market is larger, more liquid, and has more geographically diverse mine production. But the structural parallel is precise. China controls a significant portion of marginal supply, the supply that balances markets at current prices. Western markets have become structurally dependent on that marginal supply without realizing it. Restrictions are implemented suddenly, with national security justification. The initial price response is muted because the market underestimates duration and impact. Then, physical tightness becomes undeniable, and price violently reprices to reflect actual scarcity rather than paper market assumptions. Here is the specific timeline pattern from the rare earth precedent. Month 1. Announcement and initial restrictions. Price moves 5 to 8%. Market treats it as temporary noise. Month 2. Physical deliveries start getting delayed. Industrial users begin competing for available spot supply. Price moves another 12 to 18%. Month 3. Inventories visibly decline. Panic buying begins among industrial fabricators. Price acceleration becomes nonlinear. Months 4 through 6. Full supply crisis. Prices spike 200% to 700% depending on specific material and industrial criticality. We are currently in month 1 of China's silver export ban. The directive was announced 2 weeks ago. Price moved 3.8% initially and has since settled back. The market is treating this exactly like it treated rare earth restrictions in September 2010. Temporary, manageable, not a structural threat. But if the pattern holds, and I am going to show you why the structural setup is even more precarious than rare earths, the real price discovery happens in months 2 through 4. That is when Western vaults show visible, accelerating drawdowns. That is when COMEX registered inventories approach critical thresholds. That is when industrial buyers realize they cannot source material at current prices and begin bidding aggressively for available supply. The historical pattern is unambiguous. When dominant producers restrict exports of critical materials, prices do not adjust gradually. They gap violently once the market recognizes the restriction is real and sustained. So what does this actually mean for you right now? Let me break this into specific implications based on your relationship to the silver market. If you are a physical silver holder, this export ban validates the thesis that physical metal in your possession carries fundamentally different risk-return characteristics than paper claims on silver. The divergence between paper silver prices and physical availability is about to become highly visible. In normally functioning markets, price and availability move together. If price is low, supply is abundant. If supply is scarce, price rises to ration demand. But in a market where price is still largely determined by futures contract trading on COMEX, and where 98% of contracts are settled in cash rather than physical delivery, you can have a situation where paper price remains stable while physical metal becomes measurably scarce. That is exactly where we are right now. Silver is trading at $33.40, up only marginally from the export ban announcement. But physical silver in large quantities meeting delivery specifications is becoming harder to source at that price. If you hold physical silver, your metal is becoming scarce in the truest economic sense, while the paper price has not yet reflected that scarcity. That gap will close. The only question is the timeline and the magnitude. If you are an industrial silver user, particularly in electronics, solar, or automotive manufacturing, you are about to face a critical procurement decision. Do you forward buy aggressively right now at $33, accepting higher near-term costs but securing physical supply? Or do you wait, hoping the ban is temporary and prices moderate back to the low 30s? History suggests industrial users who waited during the 2010 rare earth crisis paid dramatically higher prices with severely constrained delivery reliability. Companies that secured 6 to 12 months of forward supply early maintained production schedules. Companies that waited faced production line shutdowns and emergency purchasing at peak panic prices. Industrial silver buyers are already beginning to compete for available material. That competition will intensify materially as vault inventories decline and the reality of a sustained Chinese export ban becomes undeniable. If you are a silver investor holding exposure through ETFs or futures contracts, you need to understand that you own paper claims on silver, not physical metal. And in a genuine supply crisis, those two things can diverge significantly. SLV, the largest silver ETF, holds physical silver in custodial vaults. But the prospectus includes provisions that, in certain circumstances, particularly force majeure events or custodian failures, the fund may settle in cash rather than physical delivery. PSLV, the Sprott Physical Silver Trust, has stronger physical delivery provisions, but even PSLV is constrained by available physical silver supply. If Western vaults are drawing down and Chinese supply is offline, there is a practical limit to how much new physical silver can be sourced to back new share creation. COMEX futures have always carried the theoretical risk of cash settlement rather than physical delivery. But in a genuine supply crisis, that risk increases exponentially. The COMEX has force majeure provisions. The London Metal Exchange demonstrated in the March 2022 nickel crisis that exchanges will halt trading and retroactively alter contract terms to prevent member defaults and systemic failures. I am not saying COMEX will definitely invoke force majeure. I am not saying silver ETFs will definitely fail to deliver physical metal. What I am saying is that the probability of those outcomes has increased materially, and China's export ban is the catalyst that could expose the structural difference between owning physical metal and owning a financial claim on metal. Now, let me give you 6 specific indicators to monitor over the next 90 days. These signals will tell you whether this export ban is creating the sustained supply crisis the historical pattern suggests, or whether alternative supplies emerge quickly enough to stabilize markets. Signal 1. COMEX registered inventories. This data is published daily on the CME Group website under Metals Vault Reports. You are looking specifically at the registered category, not total inventories. If registered silver drops below 50 million ounces within the next 60 days, that confirms Chinese supply was critical to maintaining vault buffers. If it stabilizes above 60 million ounces, that suggests alternative sources are filling the gap. Signal 2. Silver lease rates. Lease rates represent the cost of borrowing physical silver in the wholesale market. They directly reflect physical availability. Normal silver lease rates run 0.3% to 1.5% annualized. If lease rates spike above 5%, that signals meaningful physical tightness. If they spike above 8 to 10%, that signals crisis-level scarcity. You can track lease rates through the LBMA or specialized commodity data providers like Fast Markets. Signal 3. Shanghai silver premiums. Normally, silver in China trades at a slight discount to London or New York because China is a net exporter. If the export ban is genuine and China is retaining metal domestically, Shanghai prices should compress toward parity or even flip to a premium. That would indicate domestic Chinese buyers are competing for supply that used to be exported. Track this through Shanghai Gold Exchange daily reports. Signal 4. ETF flows and premiums. Watch for sustained large inflows into SLV and PSLV, but more importantly, watch whether shares trade at a premium to net asset value. If PSLV consistently trades 2 to 4% above NAV, that signals investors are willing to pay a premium for physically backed silver exposure because they cannot source physical metal easily elsewhere. That is a direct signal of supply stress. Signal 5. Industrial Fabricator Guidance. Major silver users like First Solar, Panasonic, and automotive Tier 1 suppliers sometimes disclose supply chain constraints in earnings calls or industry publications. If multiple industrial users publicly discuss silver sourcing difficulties or announce production adjustments due to material availability, that confirms the export ban is having real economic impact beyond financial markets. Signal 6. Chinese Official Communications. The ban was announced as subject to ongoing review with possible extension. Watch for statements from China's Ministry of Commerce around the 60-day and 90-day marks. If language shifts from temporary security measure to permanent resource conservation policy, the ban is becoming structural. If China begins granting selective licenses to specific countries or strategic partners, silver access is being weaponized as diplomatic leverage. When three or more of these signals align simultaneously, the supply crisis moves from theoretical to actual. In the 2010 rare earth crisis, lease rate spikes, inventory drawdowns, and industrial buyer panic all aligned within an 8-week window. That was when prices went vertical. If China's silver export ban follows the same pattern, we should see these signals converging between late June and early August 2026. That is the window when markets will either confirm this is a genuine structural crisis or reveal that alternative supplies have stabilized availability. So here is where we are in May 2026. China has implemented export licensing controls on silver that are functionally equivalent to a complete ban. The official justification is national security, industrial demand, and resource conservation. The real driver is strategic positioning in a fragmenting global commodity system where control of critical materials equals geopolitical leverage. Western silver vaults have been drawing down steadily for 17 months. Chinese exports have been the marginal supply preventing those drawdowns from accelerating into crisis. That supply just went offline. The market has barely reacted. Silver is up only 1.2% since the announcement. Most analysts are calling this temporary. Most market participants believe inventories are sufficient. But the historical pattern for export bans by dominant producers is clear and consistent. The initial price response is always muted. The real repricing happens 2 to 4 months later, when physical tightness becomes undeniable and industrial buyers begin panic purchasing. We are in month 1 right now. The vault data is already showing stress. The signals are there for anyone watching the physical flows rather than just price charts. I cannot tell you with absolute certainty that silver will spike in the next 90 days. I cannot guarantee COMEX inventories will fall below critical thresholds or that China's ban will become permanent. What I can tell you is that the structural setup right now is remarkably similar to the 2010 rare earth crisis, and in that case, the market dramatically underestimated the impact until it was too late to position at reasonable prices. Now I want to hear from you. Are you positioning for a potential supply crisis in silver? Are you tracking these vault inventories and physical indicators? Or do you think the market will find alternative sources quickly, and this will resolve without major price disruption? Leave your take in the comments. I genuinely want to know how this community is interpreting this event. If you want to follow this story as it develops over the next 90 days, subscribe to the Capital Wire and hit that notification bell. I will be tracking every one of those 6 signals I just outlined and updating you as the data shifts. And if this breakdown helped you see what is happening beneath the surface of this export ban, smash that like button. It helps this content reach investors who are trying to understand these critical supply chain shifts before they show up in price. The export ban is real. The vault drawdowns are real. The historical precedent is clear. The only question is whether you will position for the supply crisis before the market does. This is the Capital Wire. I'll see you in the next one.